Morning, Victor. Thanks for joining us today.
Well, thank you. It's nice here in the sunny Caribbean. I'm enjoying the weather, and I hope you're doing okay in the Northeast.
Well, we got a little less nice weather than the Caribbean. We got a nice rainstorm going here,
Yeah.
but thanks for agreeing to our first ever VicTalk, and we hope this will be a nice series of short commentaries on topical market topics of the day. And today we thought we would just start with inflation, given that Timber Point has been espousing the view that we do believe the inflation increases that we've been seeing are transitory and more driven by supply chain constraints. And we'd just like to get your thinking behind what you see in the data and why you leads you to that conclusion.
Well, let's start with what is the appropriate target. You know, the Fed tracks the PCE, the personal consumption expenditure ex food and energy. There might be a debate as to why that is the right index or not, but it doesn't matter to us. That's what the Fed watches, and that's what the Fed reacts to. So if I have here the chart of the US inflation rate on a trailing 12 month. If you look at the data, you know, like it looks like a big spike, but that spike is only 3.5%. It's nothing out of the ordinary. If you look in the back, we have had inflation rate ranging in the 2.5% to basically 1%. And that has been a pretty good run for the last 20, 30 years. Now, people are worried that inflation is going to spike out of control. And they're looking at the money supply. And when they look at, but that's only half the story. Remember, inflation is too much money chasing too few goods. We know that the money supply measures the quantity of money, but what about the demand? That's what helps us determine whether there is too much or too little money. So paying attention only to the money supply misses half the story. And in this chart, I'm trying to use a proxy for the other half. In the blue line, you will see the money supply growth, M2. And in the line below, the red line, you'll see the velocity of money. And by velocity of money is the rate at which money turns over. When people want to hold money, the velocity declines because they hold more money, they hold it in their pocket. When the money burns a hole in their pocket, they get rid of it fast away and the velocity increases. As you can see here, I have shaded, they have three shades in the graph. The first one is Y2K. That was when Alan Greenspan was worried about the Y2K was going to cause a chaos, a financial crisis. And he flooded the market with cash because he didn't think the ATMs and computer were going to work. The money supply grew at 10%, but look what happened. People held on to that money because they were worried about Y2K. The velocity declined and there was no inflation. Then we had the financial crisis, the Great Recession. The Fed expanded its balance sheet dramatically. Again, the money supply grew at a double-digit rate. And people, what happened? The velocity collapsed. People held a lot of cash because they were worried about it, and there was no inflation. The same thing happens during COVID, except that now we did it on steroids. Look at the Fed. The Fed expanded the balance sheet. The money supply grew at about 30, 40%. People are worried about inflation, but look at the velocity. The velocity of money collapsed 30, 40%, nearly offsetting all of the excess money printed by the Fed. And if you put the two together, what that means is when the Fed prints money, if the velocity offset that, there is no excess supply in the system and there should be no inflation. Now, those are theory hold water. Let's look at the next slide that I have here, that I've calculated here. No, I believe that inflation is too much money chasing too few goods. Let's look at the quantity of money, the supply. The money supply has been growing at around 12 to 13%. Fine. What about the demand for money? Well, the demand for money is the velocity has been increasing at 1.9%. So that's a reduction in demand for money. But the economy has expanded over the last 12 months at a 12.2% real GDP growth rate. That's a phenomenal increase in the demand for money. When you put the two together, we can calculate the excess money growth. The excess money growth is the growth M2 plus the increase in velocity less the real GDP growth. If you look at the numbers here, they add up to about 2.1%. So our theory says that the underlying inflation rate should be about 2.1. We know that that's not the case. We look at the PCE, the Fed favorite measure, is growing at around 3.6. There is a difference of about 1.5%. And what do we attribute that 1.5%? I would argue that that 1.5% is attributable to what? To the temporary supply chain constraints. Once the supply chain constraints are worked up and eliminated, the inflation rate should get back to around 2.5%, which is the Fed target rate. At least that's what the numbers tell me.
All right, well, it sounds like supply chain constraints could be the topic for our next VicTalk.
Absolutely.
Victor, we promised to make these short and sweet, so we appreciate your insights. And if anybody would like to follow up with you, please give me a ring. Timber Point Capital, P. Mullen at timberpointcapital.com. Thanks very much. Have a good day.
Thank you. You too.